Good morning. Welcome to the Brew. I am your host, Lex. Today we have a very live guest, Mr. Rob Hocking from SIBO. He's going to come on and talk with us about some SPX data, zero DTEs, among many other things today. He has been a guest before. He's awesome. So let's bring him out to get the show rolling. Good morning, everybody. Hi, Rob. How are you?
Wonderful. Good morning, everyone.
Good morning, Molly. I see you a lot. Good to see you again, as always. We're in the dark gray black mode. Rob followed suit with a dark vest. I love it. No one planned that. Perfect.
I know.
It looks like you're at the SIBO, Rob, by the way.
Yeah,
I
think
seem
on
to
the
be
back
walking around there a lot, and I recognize that background.
I am. This is our headquarters at the old post office.
It's so cool. I mean, SIBO went like totally vibey with this whole deal here. It's all the cool people are in that building.
It is definitely one of the nicest offices I've ever been in. So yeah. they did an amazing job on the rehab of this building.
Oh my God, I agree. It is really sweet. And that upper deck, whatever, the rooftop.
Yeah, the roof. Yep. We'll have to get up there, the basketball courts, Lex, you and me. We'll get up.
Little one-on-one. I love it. I think I put that astern playing basketball.
One-on-one, some ice for the pulled muscles afterwards will be good.
I love it. All right, well, let's get busy. So here's the deal, I think. We at Tradier are seeing just a tremendous interest in SPX trading, okay? A tremendous interest in zero DTEs, and everything around SPX. So I don't know what gives. I think it's this zero DTE thing, but I'm gonna let you break it down here in a second. But yeah, it's really, really just leaped into the forefront of trading. I've got a couple theories, but we'll chat about it. So, what are you seeing current volume trends and that sort of thing? Are you're seeing probably some of the same things, right?
Yeah, the growth continues. You're not alone in the way you kind of sum that up. If you go on a quick little history lesson here, if you look at 2019, most option brokers eliminated ticket charges. I think that was a big thing that pushed more volume to places like SIBO. You go then to 2021, the COVID pandemic really drives a boom in stay-at-home online trading. And then in 22-23, that boom continues when we introduce Tuesday, Thursdays. And I always like to, make the point that we introduced Tuesday, Thursdays, which just really rounded out the SPX offering. Prior to that, we had Monday, Wednesday, Fridays. So the concept of zero DTE existed before we introduced Tuesday, Thursdays. You just had it 3 days a week instead of 5. But really the catalyst of that Tuesday, Thursday introduction was now you had the ability to manage risk every day of the week. And with that, you were able to effectively use cheaper options because you're not paying as much theta to manage around events. And that was where I think, what really, drove the boom. So if you get to the numbers, over the last, let's call it year, we've seen a 10% increase in total options usage. Now, where a huge chunk of that's coming is in the index options world. That's really leading the way. We've seen over 40% growth there, as you mentioned, huge demand and just everyone's wanting to know what's going on in that SPX space. And so in the beginning of 2021, SPX options ADV was call it around, and I'll just use rough numbers, but it was around 1.4 million contracts a day. It was considered, 35-year-old product. It was considered fairly mature at the time. It had been around. People knew it. People used it. Institutional community used it. Now, over the past 13 months, since really the Tuesday, Thursday introduction, we've now averaged over 2.5 million contracts per day, which is just a crazy growth. For reference, the highest month in 2021 was 1.6. And so for all of, call it the last 13 months to be at 2.5, obviously this is, front and center for everyone due to, you just don't see that kind of growth very, very often. And if we go more now to just the past month, let's call it September 2023, we're averaging over 3 million contracts a day.
Wow.
just continues. I think a lot when it first came out was, is this growth sustainable? Well, I think we're proving out that, yeah, it is sustainable. People have found new utility in trading shorter dated options.
Mm-hmm.
Now, if we go into the shorter dated options, you mentioned the 0 DTE. So as I pointed out, I don't like to call it a new product because it's really not a new product. It's just a new contract, or let's call it tenor, that we really filled out our offering with.
Mm-hmm.
And you were able to trade it before, but now Monday through Friday, what has that done? Well, just over, as I mentioned, the 3 million contracts a day in September, just over 45%. I think it came in right around 47% of that volume traded the day of expiration. So in that 0 DTE bucket. Just staggering numbers.
Rob, excuse me, what was that number? Is that, you said 40%?
47%, I think, was actual. 47% of the over 3 million contracts a day was in the 0 DTE bucket.
Okay.
So big numbers. Obviously, a lot of utility there. A lot of utility. We've consistently averaged over 1.1 million contracts a day in that 0 DTE bucket for over the past year. Because once again, it kind of talks to that sustainability. I think when it first started, everybody was, oh, this is a fad. It just came out. There's going to be this influx of risk taking, I think, as you saw a lot of the articles written.
Yep.
And it will taper off. Well, I think we're seeing it's not necessarily the risk taking aspect or the one-time trade. This stuff's sustainable. People have found utility in changing how they manage around the events in the marketplace.
Okay. So Molly, I know you're going to have a question, but I'm going to go first.
Okay.
Are you sure?
Let's harvest your question.
Oh my God. Are we going to theta harvest already? So I want to just comment on one thing. So 0 DTE has been around for a while, and a lot of people truly didn't understand it. Before even Monday, Wednesday, we had 0 DTE once a month. I mean, it was called Friday.
Right.
Of expiration. Go ahead, Miles.
Lex, sorry to interrupt. Could you just introduce for people just coming onto trading what 0 DTE is, just so they understand what we're talking about?
Yeah, so all 0 DTE is trading an option the day it expires. So think of, and with index options, particularly SPX, they expire into cash. So unlike single name equity options that would expire into the physical stock, so say, a NVIDIA call might expire into owning 100 shares of NVIDIA. That's not what SPX or how SPX works. SPX works is it just settles into cash. So your account is either credited or debited with the amount of cash, either profit or loss, relative to the option that you're trading. All we're saying is, if the option's expiring today, October 4th, people are initiating new trades in an October 4th option. That's all it means.
Right.
It's expiring today.
And then the SIBO added Tuesday, Thursday to fill out the roster of now we have expiring options every day of the week.
Right.
Right.
And so before, you could only trade an option that expired the day of expiration on Monday, Wednesday, or Thursday, or Friday.
Yep.
And even what you said, Lex, I want to say it was 2016 we introduced Mondays and Wednesdays.
Yep.
Prior to that, you could only trade an option that expired on Friday.
Right. And that was once the third Friday of the month, right? So that was once a month.
That's right. And it might have been, at 2005 we introduced weeklies. So it was pretty much every Friday you would have an expiration.
Right.
So we've just kind of steadily been evolving the tenor that you're allowed to trade just through the course of time. Call it 2005 weeklies, 2016 Monday, Wednesdays to fill out each week. And now in 2022, Tuesday, Thursdays. So you have an option that expires every day of the week.
Yep. So
did that fill the...
Does that, Molly, you understand that?
Yeah, sorry. And I didn't mean to interrupt you, Lex. I just wanted to make sure before we lost everyone.
No, I'm getting used to you interrupting me. Don't worry about it.
I know. Actually, I had feedback. They're like, Molly, let Lex talk. Oh my God, sorry. I'm a girl.
Don't worry about it, Molly. So first of all, another comment. I know that when you and I talk about 0 DT, that we're like, wait a minute, it's really not. We already had this, blah, blah, blah. We're kind of snarky about it. But I think the branding is good. I think the 0 DT branding is very clever because, let's call it what it is. Most people probably didn't understand the nuance as a trader would. But in the retail world, it means something to them.
Yeah.
And I think it's a poignant sort of branding, sort of genius. And I don't know if you guys planned on that at all, but
No,
to me, it's great.
Yeah, I would argue we didn't plan on it. And I think, I might be, as my role here at the exchange is the head of product innovation, building new products. I'm just always quick to say it because people come and they're like, wow, you built this new product. And it's like, no, I can't even take credit for that. We didn't really build a new product. We more just, we added air conditioning to an existing car. It was just a feature.
Right.
And so the product has always existed. SPX has been around, for 35 plus years. So yes, to your point, I think the branding helps. Obviously the visibility into the SPX complex has been phenomenal. We'll take that. But it's, as far as a new product versus an existing product, I agree with you. There's just some nuances that I'm probably overly sensitive to.
Yeah. No, I get it. Okay. So let's talk about who's trading this zero DTE. So I mentioned retail. Clearly they have interest in it. Market makers always have to trade it anyway because they make two-sided markets, so they're already involved. Period. Right. So who's driving this? This surge in volume on these things. In terms of a sector, would you say?
Yeah. So it's a great question. We have limited visibility into that. So I'll give the caveat: we don't control clearing, so we can't see where this position ultimately resides.
Yep.
What we can tell you is that roughly, let's call it 90% of this zero DTE volume is coming into our exchange through retail broker platforms.
Okay.
So that doesn't necessarily mean retail. I think that's a quick jump where everybody goes to. But what it means is a retail broker platform. So there's platforms out there like IB that many are familiar with that are using algos to trade and things like that. I would not put that as in the camp of the individual retail investor. Like, those are pretty sophisticated people using some of those algos and some of those pipes, but it's coming through a retail broker platform. We have done some qualitative analysis to try to get a sharper edge on where it's coming from. At last, we want to say it's about 60% institutional and about 40% more that retail individual investor that we see.
Okay.
And so the more importantly, it's like, what are they trading? And I know there's been a lot of articles out there, and I call it more fear mongering in a way. It's, what is this doing to the market stability? Is this causing instability in the market? One thing I like to point out is that of these trades, let's call it 70% of them are closed out before the end of the day. So you initiate them in the morning, many right out of the gates in that first half hour of the day, and then are closed out by, say, 2:00 Chicago time in the afternoon.
Okay.
Roughly 70% doesn't go into expiry, which is a fairly large number. It's an in and out type trade, a momentum type trade for the day.
Right.
What I also like to point out, and where we've gone for a lot of our regulators to give them a bigger picture, is I am calling 95% of what's being traded as defined risk or limited risk.
Okay.
And so what do I mean by that? 45% and this is, I'm referring to customer originating trades, like customer opening trades that are tagged in our system as a customer and opening. 45% are buying single leg options. So the most they can lose is the premium they spent. Super simple. Maybe they're doing a momentum trade. They think the market's going up, so they buy a call, hope to capture that upside movement. But they're defined risk. They can't lose more than the premium. Another 40, let's call it percent, are selling complex orders, so spreads. Once again, as you know, the most you can lose is the amount of money between the strike. So if I sell a $10 call spread for $2, the most I can lose is $8. Right. It's defined risk. It can't blow up on me. 10% are buying complex orders. So think put spread, call spread, maybe just reducing the premium to get that upside or downside move through a spread. And it's the last 5% that we see that are actually selling single leg options.
Like just naked selling?
Naked selling, where I would call unlimited risk. So if you think about, yes, large number trading, but 95% of it is, call it defined risk, what I think a lot of people use options for in the first place, which is defining that portfolio, making sure their risks are covered. It's really not as naked short selling, I think, as some of the articles and some of the media tends to make it sound like.
Right.
And then I would add one last thing, and I know you have more questions, so I won't make this answer too long. The range of strikes that we're seeing people trade is very diversified. It's not all centered at the money like you would think a meme stock event that we saw, call it over a year ago, that we saw in the single names. It's not just this concentrated, everybody's going in for the same strike, the same risk exposure. It's you have all of these different strategies that people are using, and they're using them across a wide range of strikes. So you just don't have that strike concentration that also, to me, adds risk to the market.
Okay. So, having said what you said, it makes sense to me, the defined risk part of it, right? Is your suspicion that retail folks get in there early, they try to sell a call spread, sell a puts, but are doing iron condor, harvest some theta, mall, and then get out of this thing at noon, 1 o'clock, whatever. Is that what kind of, in a grand oversimplification is going on with the retail folks, do you think?
I think there's a lot of that going on. I think it's a function of they set their entry and exit points and their stop loss, so to speak, and they put it on when they capture what they're after. Yes, they're taking it off, or if it goes against them, they're getting out of it at their stop loss.
Okay.
Each, though, is pretty, what we've seen is pretty, let's call it defined, or what's the word I'm looking for? Like they're very much being responsible with how they're attacking the market. It's not emotional trading as can happen.
Right. Okay. Got it. Is there a 0 DTE in any other product at SIBO? I can't remember.
So we're looking, great question. We're looking to add them to some of the other index products like Russell.
Yep.
We've had some demand for that. But they're obviously not in the single names. And SPX really is driving all of the real volume in these trades.
Yeah, I mean, I think SPX being European as well. I mean, not that it doesn't. I guess it doesn't matter on a 0 DTE because it's expiring that day anyhow. But expiring in the cash is a big deal I know that's a big deal for retail folks, because that's when they get in trouble, is when they get an underlying asset at expiration. They're like, oh, geez, what do I do now?
That's right. Like your risk is gone at the end of the day. Like you might have P&L risk because the cash that's going in and out of your account exists. But that idea that, oh man, I'm now long shares that I now have to go get out of, and I have to get out of them after the market's closed. So I own the overnight risk. Like that's a different dynamic completely.
Sure. Let me pull in a question here, Rob, from someone. So let's just answer this. I just noticed this. We might have already answered this, but I'll let you read that. See if you make any sense out of that.
Price movement, is it 100% based on the composition of the underlying stocks, or does SPX option volume also factor into this? Well, obviously, I think it's a combination of both. Volume changes in even intraday volatility, gamma, how the gamma of the option is playing out that day, and is there demand for either long or short gamma depending on the day's events. These options tend to be much more heavily, let's call it a gamma trade than a vol trade, just because of the nature of it being one day. But how that works, I think, and what sort of day, what sort of environment you're in, definitely dictates, kind of call it the pricing of these options. So it's not just the price movement, it's some of these other factors, supply and demand of what they're being used for.
Okay.
Hopefully that answers the question.
Yeah, no, that's great. Molly, are you okay over there?
I do.
You still have the seatbelts on, right?
I have them stored, my questions. So whenever you're ready, I'm listening.
No, go ahead. Ask Rob a question. Don't be afraid.
All right, Rob. All right, no whammies, Rob.
Wait, first of all, hold on. Sorry. Just so you know, Rob, Miss Conspiracy Theorist over here. You never know where this is going to go. Okay, so stay with us.
I like it.
Gentle.
I like it.
Gentle. All right, so the 390. So these are high frequency. So you aren't waiting 30 days, and so for a new retail trader, these can be every day. So how does the 390 professional order rule sort of come into play when you have a lot of trades?
Did you Google that, the 390 rule?
The only way I keep up with you, Lex.
This has to be the pattern day trade.
That's what it is.
I don't memorize them by their number. I apologize.
But yeah, it's just that if you have, there's 300, if you trade a lot. So if you have a high frequency of trades.
Correct. I think that's definitely something that's factoring in for customers. We have less exposure to that in the sense of the retail broker platforms tend to take care of all of this for their clients. So some will actually monitor their trading and cut them off before they hit pattern day trader status. Others obviously let them, but there's the requirements that follow through with it. It's something that I think the industry needs to address. I think the reason you had pattern day trade rules previously, if we go back to when they were instituted, it's a very different market now than it was back then. And the reason those rules were in place were really to protect investors. And while they still need to protect investors, I think there could be a modernization of those rules around the fact that everybody is making day trades. And that day trade, because it's expiring into cash, because the position is rolling off, it's not like you're taking a 30-day position and you keep rolling around risk and you keep having things multiply and move around like what Lex and I used to do back in our portfolio trading.
Right.
This is now defined risk. It rolls off each day. If you're doing some sort of yield enhancement strategy where you're selling a call spread, you have capped risk, you're just collecting that yield every day of option premium. That to me is a different day trade than what was previously taking place. So it is something that is affecting traders. They should be aware of it. They should definitely talk to their retail broker platform about how it might impact them or what safeguards that platform has in place. But also know at the exchange level, because that's our job, we are addressing it with many of our industry participants in can we modernize the rule to make it fit better and to give people the flexibility that maybe they desire.
And that rule didn't originate with SEC; it originated with SIBO. Is that correct?
I believe so. Yes, in the history, you're really digging deep in the history lesson. I love it. Yes,
but
I believe
you're Supreme Commander, so you're going to just take care of that for us, right?
SIBO was the one that initiated it, and that is why I would say we're very much leading the charge to readdress it.
Okay.
Yeah, you're digging in back when I wasn't the SIBO person. Now you're.
It's not your fault. It's not.
I got to go back to my 390. I'm gonna do that after this.
She's lifting stones again, looking for spiders. I'm telling you right now.
I love it. That was a nice curveball.
Good curveball, Mal.
Yeah, I've got one more. So whenever you guys are ready.
Go ahead, Mal. Go ahead. You're theta harvesting already. I
know. So because of frequency, so I know in 2024 we're going to unleash the T+1 clearing, so that'll come into play. Is this causing that upgrade for clearinghouses?
I don't know if I would say it's causing it. I think the light on zero DTE trading has brought a lot of questions, like the pattern day trader question, into focus. I think anytime, and there's always been demand, you don't want your money tied up. You want a quicker turnover. And I would argue technology has gotten better to the point where we can produce those things. So to me, it's the right modernization or evolution of clearing systems to be able to do something like that. Was zero DTE the catalyst? For some, maybe. I would argue that this is more just, to me, the right evolution of where the industry should be headed. I would actually argue, some of the tokenization in crypto market has probably brought some of this to focus as well. Right. And what can we do to improve systems there as well?
Yeah, and the reason I ask these questions is like you say, I don't like to talk about the media kind of boohoos the zero DTEs because of risk, but I really like to look to the future because retail traders are just growing and they're not going anywhere. And so how are we gonna evolve altogether? So I love these changes that are happening, which is really neat.
Yeah, absolutely. They're needed. And I think the systems and the technology now can support them. And so it's definitely something we as an exchange and as an industry need to address.
Great. Thank
you,
Rob.
So you mentioned earlier, Rob, I think when we first started, there have been papers written about zero DTE, some that have suggested that it could accelerate volatility. Others have been written completely the opposite. And the accelerate volatility are the people who like, all these market makers are getting short this stuff somehow, and they're going to be moving things around, gamma hedging, and we could have a Volmageddon and an Armageddon, whatever. Where do you fall in any of these camps, or is it just too hard to say?
I don't think I fall in any of the camps. I think right now the only thing the exchange can do is rely on the data that we see.
Yep.
And the data that we see, one, it could never be a Volmageddon-like situation, because when that headline first came out, that one is just Volmageddon was caused by a very one-sided position coming into the market that was established over a long period of time. Let's call it a year plus.
Okay.
If you look at the way vols traded in 2017 and the short vol phenomenon and the headlines you saw where, a Target store manager was using XIV to short vol, and like you saw how that trade developed, that's not zero DTE. Like you can't have a trend trade really happening in the fact of the position's gone at the end of the day. So how do I build up that massive inventory over time? So it's definitely not a Volmageddon. So can it cause more market instability? We're not seeing that in the data. Can it? I don't know. I don't want to say yes or no, but that's not what we're seeing in the data.
Yep.
We talk about, from a market maker perspective, because you mentioned, Lex, that's really what kind of drives that movement. How are market makers hedging against the people that are buying and holding these strategies and inventory?
Mm-hmm.
The market maker imbalances aren't there. Like I said, the strike concentration isn't there. The market maker imbalances aren't there. As we see large trades, and you can pick some of the very large volume days that we've seen in zero DTE, and you watch how the market makers are responding to that flow, you're seeing, one section, it'll be, a 15-minute window, they're net long, a couple hundred contracts.
Mm-hmm.
Then they're net short a couple hundred contracts. Then they're net long a couple hundred contracts. Like they're doing exactly what a market maker does.
Yep.
Is standing there providing that liquidity and never really getting that out of balance position that would cause something that people are afraid this might cause. So we're just not seeing it in the data yet.
Okay, good. And the other thing I heard, someone in the community, the market making community, that is, mentioned that I won't give any names, but they have a team dedicated to zero DTE who trade and hedge that exclusively from the rest of the portfolio potentially.
That's
which,
right.
To me, I thought about that. I'm like, yeah, I guess that kind of makes sense. Since this is happening every day now, it probably makes sense to kind of, build this as a product in and of itself for a market making shop. But I could also see the other side too, but I like the idea. I
would argue in my old chair, we probably would have done something similar. I mean, you're looking at a vol book versus a gamma book, and how one will kind of cloud the other, and they might cloud each. So to separate it, I think could make a ton of sense for how some people run their businesses.
Sure. Okay. Let's cover a couple more topics here if we can. I see the time. So regular hours versus the extended with these things. Can you comment a little bit about this? I know we have gotten a lot of interest in after hours options trading, right? Someone asked me about it yesterday, as a matter of fact. My first blush is to say, be careful, only because I always, and even in my professional career, I always saw very little liquidity and lots of wild potential swings in after hours markets. It's just didn't seem as liquid as normal hours. So, granted, if we all go that way, we'll start seeing a little bit more liquidity. What are your thoughts on the drive of this? And it's super interesting for folks.
Yeah, no, I agree with you. I think we're starting to see good growth in overnight liquidity as well as overnight demand. Where that growth is primarily coming from right now is, let's call it right after the market closes, what we call kind of a curb session, where people are cleaning up risk, right? Maybe something they got at the end of the day or something they just didn't have a chance to position for. And then really the largest area we're seeing in our global trading hours or after hours is that 8 to 9 Eastern time window right before the market opens. So I do think people are starting to get in early and position. But overall, if you look at just GTH volume, we're at really 4x what we were in 2022 and 23. Mm-hmm. So it's growing quickly. And I think, to your point, Lex, if we continue that growth rate, which we're seeing more and more demand from customers overseas on their market hours, mm-hmm. if we continue to see the growth rate, the market making groups have already said, we'll be here to trade. That's what we do. That's how we make our money. Sure. So we just need to see the flow. So I think as the flow continues to come, the market makers will continue to step up, and you'll continue to see tighter and tighter liquidity, hopefully someday getting to the point where it's kind of seamless 24/5.
Okay.
I think one thing we might want to look at too is DTCC just, is launched Project Ion, which is clearing on a distributed ledger. So that would enable real-time clearing after hours. And the only difference is that they're holding all the ledgers centrally. So this is the same conversation you'd have with CBDC versus Bitcoin. So the holding of the ledgers doesn't really make it,
right. It's
distributed.
great
What do you think about that?
It's stuff that we're exploring. I don't think it's quite there yet. Not to the degree that we need it for. If you look at, and I don't even know the number off the top of my head, but you look at the amount of options that OCC clears on a daily basis. Distributed ledger technology just isn't there yet. Will it be someday?
I think they're only doing 10,000. I think it's just like a little tiny pair.
And the nature of only using it in after hours doesn't really work either, because you just still need to keep this all in the same spot, same technology, same platform. But we're getting there. It's exciting to see where those developments are coming.
Yeah, and I would love to see them not in a central ledger. So I don't ever like to see, I'd love to see a disbursement. So on every trader's computer, they have a piece of that ledger. That would be better.
Right.
Mm-hmm. You're like, it's almost like blockchain, Mal.
It is. I feel like I need a drink on that.
Unbelievable.
Like said blockchain. Yeah.
Last topic real quick. XSP versus SPX. We've certainly seen a little interest in XSP. I don't want to badmouth one versus the other. First, can you just give us a little explanation of XSP, which I happen to like a lot, especially for the retail person, and you probably know why. But what are you seeing in XSP of late? Anything new and exciting going on there?
It's a great product. I use it personally. I think it is effectively the mini SPX. So think spider level, but cash settled index option. And we go back to that cash settlement piece. So if I'm trading SPY options, I'm getting delivered SPY stock. And there's a lot of times I don't want that.
Right.
I just want that cash transaction if I'm overwriting or so forth. So we launched Tuesday, Thursdays in XSP in October of 2022, a little bit after we did it in the big product. And we continue to see it's a growth story. We continue to see with ADVs almost doubling since that time. Now, excuse me, albeit it was up off a much lower base, like we're starting with a much smaller kind of overall number, but the growth is there. One big catalyst to XSP that I think your audience might be interested in, we are currently working on, we had submitted a rule change to the SEC that was approved in March. We're now waiting for FINRA to do effectively their own version of this rule filing with the SEC. But it is a margin rule to where it would allow for margin relief of a cash settled index option written against an ETF. So think XSP written over SPY.
Okay.
Right now, if you were to do that trade, they look at the two independently. So you don't get that offset of, hey, I'm long SPY stock, but I'm short a call, like you would with SPY calls against SPY stock.
Sure.
Because the XSP is the mini SPX and it tracks SPY, it's a great overwriting tool because of the cash, like we talked about. I won't have a taxable event maybe in my SPY stock getting called away if I'm overwriting a cash settled XSP option.
Love it.
And so we think that will be very big to get that, get that beneficial margin treatment for an XSP option and the benefits of cash settled against the SPY. So we're waiting on that one. It sits right now between FINRA and the SEC, and I think it's in the approval process right now. That it's like the comment period at the SEC. But we see big opportunity to continue the growth story of XSP.
Right. So some of the comments I've heard, and I say, well, why don't you just trade XSP? Obvious comments. Well, it's not as liquid as SPX. And I know that, it's a new product. It's probably at the money's very liquid. When you get in the money, deeper, bigger options, maybe not as much, but I think it's getting there. I think you're right. Once again, volume, or I shouldn't say volume, order flow is what ends up tightening those markets. So I'd encourage any user, you're not going to lift and hit those markets, that they are still a little bit wider than we would like them to be. But you throw an order out there, you throw it out there mid-market, you throw it out, inside of that bid offer, and chances are you're going to see them get executed. Because that liquidity, I think, sits there. The same firms that are providing liquidity in the SPX
are sitting there in XSP. They're the same product. It's just a different multiplier.
Yep.
So it's a function of seeing the flow come into that product that will, I think, naturally drive those markets tighter.
Right. Right. Yeah. And then they trade in pennies, right? XSP, they have
Right.
penny. Okay.
Right.
So I think that was one of the, another one of the comments about SPX versus XSP, the nickels versus pennies for the retail folks. A lot of the automated bot type folks love the penny part of it because, clearly they can get in and out for smaller numbers.
Well, there's tax benefits. There's all sorts of, like, we don't go into it all today, but it's on the web. It's on the SIBO website. Like, go check out XSP because it really, there's a lot of benefits to trading a SPY option relative. I think it's a compelling argument.
Yeah. Cool. All right. Well, great, Rob. Molly, you have any other questions? I'm gonna let Rob get back to his day job here. Okay.
No. I'll let you guys go. I'll let you guys go.
No,
well,
Molly wants to ask you a question, but
I can
come
see
on,
it.
Molly. One more. One more.
So is that true that iron butterflies and iron condors are the top 0 DTEs? I mean, not the top, as you said, selling a call would be the go-to. I think you said what, 47%?
Right.
Is it 47? Yeah. So are butterflies and condors traded a lot in this area, and why?
I like that one, Mal.
I think they are actively used. They're very actively used. We tend to bucket everything just in complex versus non-complex. So think one leg versus multiple leg. So we don't really go too much into the granularity of exactly each strategy. But a lot of it, yes, is call it, I always say, graph the payout of that structure. Look at the payout relative to the market conditions. And a lot of this is yield capturing. A lot of those two, spreads, condors, iron condors, they all tend to be, heavily used to capture that premium with limited risk and tails around, different positioning of people's portfolios. They're actively used. I think they can be very beneficial if used correctly. And I always have to give the disclaimer: I don't give investment advice, so please talk to your broker for making sure you're doing the right thing. But yes, I think they can be, a useful strategy for some.
Cool.
Okay, great.
Good. All right, Rob, we're going to let you go. Thanks so much for coming on. It's always, I love having you. You're awesome.
Yeah.
You give us such great information and so such in-depth analysis. Really appreciate it. Rob's from SIBO, one of our favorite exchanges. Well, I got to say that about every exchange.
Right.
So because you're on, I'm saying you're one of our favorites.
I get it. Love it. Thanks for having me, guys. Always happy to come. So
yeah, thanks so much. We'll do it again. I've got a few
Rob.
topics for you queued up for you, man. We're gonna hit them. So
awesome.
All right, you guys have a great day. Tomorrow, Traders Workshop with the lads. So be prepared for that and have a good day, everybody. Thanks.
Bye, everyone.